Apple stock is now trading at a 52-week low. We can see they're trading at $124.63 per share, but over the past year, they're down over 30%, and this led to a pretty drastic drop in their overall market cap. We can see their market cap decreased by $755 billion in 2022 alone. And so while the macroeconomic headwinds are definitely causing some of the downfall, we can also see things like Apple cutting their MacBook and Apple Watch production levels is definitely not going to help with their share price either. So in this video, we're going to be jumping into my stock valuation spreadsheet to see if we can find the intrinsic value of Apple stock. We'll be looking at different valuations such as Graham's valuation, a discounted cash flow, a multiples valuation, and a dividend discount model. And like always, if you'd like to be able to download this spreadsheet, then you can head over to my Patreon page at the link in the description. But okay, so the first thing we'll do is we'll come up here and plug in the stock ticker and hit enter, and you can see all of this data is going to automatically load in. Now, I'm a dividend investor, so I always pay close attention to our dividend data here. We can see they're currently paying out 92 cents per share, which gives them a pretty low starting dividend yield of just 0.74%, but they also have a really nice low payout ratio, just 14.6%, meaning they have plenty of room to continue to increase that dividend payout over time. Now, if we come down here, we can see analysts currently have a target price of $176 per share. That is quite a bit higher than that current trading price. The institutional ownership is honestly a little bit lower than I was expecting to see at about 60%, and the beta is sitting at 1.21, which means you will see a little bit more volatility with this stock. But let's go ahead and look at our first valuation, and that is going to be Graham's valuation, a valuation model invented by Benjamin Graham. And here's the formula he lays out for us to calculate intrinsic value. So you can see the first variable we need is the earnings per share, which we have right here. And then we have our growth rate projection. I'm actually staying pretty close to what analysts are projecting, depending on which website you look at, with a growth rate projection of 12. We then multiply that by 4.4, which is the average yield of AAA corporate bonds, and divide by Y, which is the current yield on AAA corporate bonds, which is a lot higher than it has been over the past 3 years, sitting at 4.65, which leads to an intrinsic value of about $110 per share. Now, just about 2 or 3 years ago, this number was sitting a lot closer to around 2.5, and when we plug that in, you can see we get a way different valuation. So definitely the current market conditions are playing a role to this lower valuation with this model. But let's go ahead and jump into our next valuation, which is going to be our discounted cash flow analysis. And if you're not familiar with this valuation model, essentially what it does is it values a company based on how much they're projecting the future free cash flows for this company will be. So in order to do this, we need to project a growth rate to the future free cash flow. So you can see right here, I plugged in the historical free cash flow so we can see our year-over-year growth rates for this company. It's sat at around 12.75%. So again, I'm going to project a growth rate of about 12% to the future free cash flows. So I projected that growth rate all the way through the year 2031 and used it to calculate the terminal value, which is the sum of all the future free cash flows past the year 2031. I then took the present value of those future free cash flows and added them together here, added the company's cash and subtracted out their total debt to find their equity value. Once I had that, I divided by the shares outstanding and I came to a discounted cash flow price per share of $177.23, which if we jump back over to our stock screener, we can see that's actually very close to what analyst target price is as well. But let's go ahead and look at our multiples valuation. I think this is a really important valuation model to look at no matter what the company is, but essentially what we're doing is we're looking at companies that are similar in structure and looking at a price to earnings multiple, because essentially that's a way to see how the market is valuing those companies based on how much they produce in earnings. So you can see the comparable companies right here, their stock price, earnings per share, which gives us that price to earnings multiple. We then take the average price to earnings multiple for those companies, multiply it by Apple's earnings per share when we come to an intrinsic value of $147.62 per share. Now, the last valuation model that we typically look at is the dividend discount model, but we really don't get a fair valuation with this valuation model when we look at Apple, because the value they produce does really not come in the form of dividends. So like we saw earlier, they do have a little bit of a dividend, as we can see, dividend yield of 0.74%. They also have a little bit of decent dividend growth, close to 6% over the last few years, but even then, with a growth rate projection of 6%, it really doesn't come out to a proper valuation for this company. So because of that, we're actually not going to be using that in our output, as we can see right here. But with that being said, we came to Graham's valuation of around 110, multiples of 148, and discounted cash flow really strong at around 177. And when we average those three together, we come to an intrinsic value of about $145 and 3 cents per share. Now, as a value dividend investor, we do always want to apply a margin of safety. So let's say we apply a 20% margin of safety. In this scenario, our acceptable buy price for this company is around $116.02 per share, meaning it's getting very close to being in that acceptable buy range. But obviously that's going to depend on your margin of safety. So there you go. There's a quick analysis on Apple stock. I still think there's a whole lot of value here, but obviously if you're really focused on increasing your dividend income, they do have a low starting dividend yield, and there's not a whole lot of dividend growth at this time. Maybe that will change in the future, but I think there's still a little bit of a value play, you could argue, right here. So there you go. If you'd like to be able to download this spreadsheet, then you can head over to my Patreon page at the link in the description. So that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.